When people start investing, one of the biggest assumptions they make is this: if it's a great company, it must be a great investment. It sounds logical. After all, if a company makes amazing products, dominates its industry, and everyone loves it, buying the stock should make you money, right? Not necessarily. In fact, some of the most famous companies in the world have been terrible investments at certain points in time. The key lesson for beginner investors is this: a great company is not the same thing as a great stock. Today, we're going to look at why that happens and a few famous examples that show how investors can get it wrong. Let's start with the core idea. A stock price doesn't just reflect how good a company is today. It reflects what investors expect the company to do in the future. If expectations become too optimistic, the stock price can rise far beyond what the company can realistically deliver. When that happens, even if the company continues to perform well, the stock can still disappoint investors. One classic example is Cisco during the dot-com bubble. In the late 1990s, Cisco was one of the most important companies powering the internet. It built networking equipment that helped connect the entire world online. The business was incredibly successful and growing rapidly. Investors became so excited that Cisco briefly became the most valuable company in the world in the year 2000. But the problem wasn't the company. The problem was the price. Cisco's valuation became so extreme that even years of strong growth couldn't justify it. After the dot-com bubble burst, the stock fell dramatically. And here's the shocking part. Even decades later, the stock took an incredibly long time to recover to those bubble-era highs. The company remained profitable and successful, but investors who bought at the peak waited many years just to break even. Another example is Coca-Cola in the late 1990s. Coca-Cola is one of the most iconic brands on earth. It sells products in almost every country and has one of the strongest distribution systems ever built. But during the market excitement of the late 90s, investors pushed the stock price extremely high. The company was fantastic, but the expectations baked into the stock price were even bigger. Over the next decade, Coca-Cola continued selling billions of drinks, but the stock went almost nowhere. Again, nothing was wrong with the company itself. The issue was that investors paid too much. A more modern example is Netflix. Netflix is a revolutionary company that completely changed how the world watches entertainment. But its stock has also experienced massive swings. At different times, investors have priced Netflix for near-perfect growth. When the company inevitably faced slower subscriber growth or higher competition, the stock dropped sharply. This shows another important investing truth. Stocks move based on expectations, not just results. So what can beginner investors learn from these examples? First, always remember that price matters. Even the best company in the world can become a bad investment if you pay too much for it. Imagine buying a house worth $500,000 for $2 million. The house might be beautiful, but financially, it's still a terrible deal. Stocks work the same way. Second, be careful during hype cycles. When an industry becomes extremely popular, whether it's dot-com companies in 2000, cryptocurrencies, electric vehicles, or artificial intelligence, investors often push prices far above reasonable levels. Excitement can make people forget basic investing principles. Third, focus on valuation, not just quality. Great investors don't only ask, is this a good company? They also ask, is this a good price? The combination of a strong business and a reasonable valuation is what creates great long-term investments. Finally, think long-term and stay patient. Markets constantly swing between optimism and pessimism. Sometimes great companies become overpriced. Other times, they become undervalued. Successful investors try to stay rational while everyone else is emotional. So the next time you hear someone say, "This company is amazing, I'm buying the stock," remember the lesson from today's video. A great company can still be a terrible investment if you pay the wrong price. And learning that difference is one of the most important steps in becoming a smarter investor.